Welcome to our comprehensive guide on the research credit. Today, we'll navigate the history, definitions, and calculations of this vital tax incentive. Congress introduced the Credit for Increasing Research Activities in 1981. It was designed to stimulate capital formation and increase productivity by incentivizing taxpayers to undertake new research. In general, the credit was equal to a percentage of the amount by which a taxpayer's qualified research expenses exceeded their average expenses from the 3 preceding tax years. Congress extended the credit multiple times, occasionally letting it expire before reinstating it. Finally, in 2015, the research credit was made permanent, providing long-term certainty for businesses. Section 38 permits a credit against tax for current year business credits, which includes the credit under Section 41 for increasing research activities. For S corporations, the Section 41 credit is allocated among shareholders pro rata. Each shareholder then claims the credit on their own income tax return. Section 41 describes 5 methods for calculation. Most small to mid-sized businesses use the alternative simplified method, which compares current year expenses to a 3-year baseline. To understand the credit, we must navigate statutory definitions. Qualified research expenses, or QREs, are the sum of in-house and contract research expenses. In-house expenses include wages paid to employees for qualified services and the cost of supplies used in conducting qualified research. Qualified services mean engaging in research, direct supervision, or direct support. Note that direct supervision does not include higher-level management. Under Section 41, 4 specific requirements must be met for an activity to be considered qualified research. Let's break them down. First is the Section 174 test. The taxpayer must show that information objectively available did not establish the appropriate design, and that they undertook activities to eliminate that uncertainty. Second, the research must be technological in nature, relying on principles of physical or biological sciences, engineering, or computer science. Third, the research must be intended to be useful in the development of a new or improved business component, such as a product, process, or technique. Finally, substantially all activities must constitute a process of experimentation, designed to evaluate alternatives where the design was uncertain at the beginning. Certain research is excluded, including research conducted after commercial production begins, foreign research, and research in social sciences, arts, or humanities. For small to mid-sized businesses, the process is simple. Identify research activities, apply the 4-part test to each, and then determine the relevant QREs. If an employee spends at least 80% of their time on qualified services, all of their wages can be treated as an in-house research expense. Under the alternative simplified method, the credit is 14% of the excess QREs over 50% of the 3-year average. Without a history, it's a flat 6%. Let's look at a practice example. Imagine a business with $1 million in current QREs and a $1 million average over the 3 preceding years. The base amount is 50% of the average, which is $500,000. Subtracting that from the current $1 million gives $500,000 in excess. At 14%, the total credit is $70,000. Now, consider a business with no qualified research history. Using that same $1 million in current year QREs, the calculation simplifies. With no historical baseline, we simply multiply the current expenses by 6%. This brings the total calculated research credit to $60,000. Understanding the research credit can unlock significant tax savings for your business. We hope this guide has made the complex statutory web a bit easier to navigate.